Happy New Year. Welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. And we'll cover key opportunities and risks for investors tied to developments around the world. Oh, and we take your live questions from the chat on YouTube, so you can ask us what's on your mind at any time by entering it into the chat. And then we'll get to those questions in just a few minutes after we share some of our latest insights. Now, we've got a lot to cover, but first, we've got a few required disclosures before we get started. We don't know you personally, so we don't make personalized recommendations, but we generally talk about the markets, sectors, and areas of investing we think are likely to perform well or poorly, and why, though we don't provide an outlook for specific stocks. And of course, things can do change, so all our thoughts are subject to change as well. And investing has risks, and international investing has unique risks like currency moves, so please keep all that in mind. Now, as is the case every week, I'm joined by Michelle Gibley and Heather O'Leary here on the Global Strategy team at Charles Schwab. Good morning, ladies.
Good morning. Happy New Year.
Good morning and Happy New Year. Glad to be here. Just as usual, I will be watching the chat and questions closely, so keep sending them in and we will get to those in a little bit. But let's start out with Jeff. What are you watching this week?
Yeah, thanks for asking. So today, the Washington Post indicated that the Trump team may be planning to limit U.S. import tariffs to sensitive items rather than the across-the-board tariffs that Trump campaigned on, and that we said would be difficult to implement both legally and economically. And that's helping power today's gains. The tariff story is clearly going to be one of the biggest themes for 2025, so not surprisingly, any news on that would move the markets this morning on Monday. Tuesday kicks off the major technology show, the Consumer Electronics Show 2025, the CES in Las Vegas. That's going to run through Friday. There's going to be news coming out of there that could affect the tech sector. The CEO of the S&P 500's top performing stock, NVIDIA, is set to deliver a keynote speech, so that'll be closely watched by investors. Then next day, Wednesday, we get the Fed minutes to the December meeting. The Fed Chair Powell, back at that meeting, Fed Chair Powell said the decision to cut rates at the December FOMC meeting was a, quote, closer call. And minutes of the meeting will give additional details on those deliberations. They also should offer some detail on how policymakers have updated their outlooks and the balance of risks based on recent data and policy proposals from the incoming administration. So that'll be interesting to watch. Participants likely incorporated an extension of the personal income provisions in the Tax Cut and Jobs Act of 2017, getting that extended. Those were set to expire at the end of 2025, but not a sharp increase in tariffs or drastic spending cuts. But we'll see how that all shaped up in their outlook for the year when we get that data on Wednesday. On Thursday, the stock market's going to be closed for the U.S. State Funeral and National Day of Mourning for former President Jimmy Carter. But then on Friday, big news, both Canada and the U.S. deliver December jobs reports. December U.S. jobs data looms large in the thinking of Fed officials. Estimates put non-farm payroll growth at a net gain of 160,000 for the month, down from a better than expected 227,000 we got in November. December's unemployment rate might tick up to 4.3%. Remember, the actual job count comes from surveys of businesses, but the actual unemployment rate comes from the outlook for households, surveys of households. So two different sources for that data. And that's why you could still see a relatively solid number of jobs, but a potential for an uptick in the unemployment rate to 4.3%. That will be a third consecutive monthly rise. Could be a surprise if that happens. The key reason for a potential uptick, despite subdued layoffs, initial jobless claims still remain fairly low, is we're seeing a plummeting rate of new hiring. The median duration of unemployment has climbed steadily throughout last year. It's now 10 and a half weeks. The latest data we have is in November. So even without mass layoffs, the ranks of the unemployed are swelling as it's been harder to find work. Now, stocks are up 1% so far today, and I want to give an update on market performance since Election Day. As you can see in this chart that we've been putting out really since Election Day, really I think just ahead of Election Day, we started to show this. The market slightly lagged the typical path that stocks take during the transition to a new administration from Election Day to Inauguration Day, right? So the start of this is Election Day. The end of this chart is Inauguration Day, looking back over the last 50 years. Now, the chart's through Friday. The bright red line is the current experience, the current transition period we're in. Doesn't account for today's rise, but we're not surprised by the lack of material losses. That was kind of the point of this chart when we put it out, back at the beginning of November. The idea was, unless we're in a recessionary bear market like we were during those two blue lines there at the bottom, we generally see modest gains during this period of time. Maybe the only surprise is not more volatility that we thought could make a bumpy ride for investors over this period of time. But you add another maybe 1% gain there today on that red line, and you get something pretty close to average, maybe slightly below average. So no surprises there. But even more interesting, maybe the performance of emerging market stocks from election day to inauguration day. If we look back at 2016 into 2017, we're seeing a similar pattern play out here this time around. A similar pattern seems to have unfolded. So that orange line is what happened last time, right? Big drop as Trump got elected, and then a rally, and then a drop again, and then a rebound. This blue line is what we're seeing this time. So kind of an echo of that pattern. Since election day, we've seen the market interpret President-elect Trump's America First policies as good for U.S. small cap stocks, followed by U.S. large cap stocks, and bad news for international stocks. And even worse news for emerging market stocks like China that'd be subject to those tariffs. And market behavior has mirrored that performance. You can see this is shaped up similar to what we saw in 2016. Back then, U.S. small caps led the gains, followed by U.S. large caps, and emerging market stocks, including China, suffered the most. But that quickly changed back then. During the first year of Trump's term in 2017, emerging market stocks were the best performers, led by China. China had a 56% total return in 2017. Despite all the concerns about uncertainty and tariffs and trade wars. And then that was followed by the outperformance of developed international stocks. They also outperformed the S&P 500. Bring up the rear were U.S. small caps. So you can see on this chart, really interesting to see the U.S. S&P 500 and then international stocks and then emerging market stocks in that transition period. But what happened in the first year of Trump's administration? Well, you can see there in 2017, very different, right? Emerging market stocks, international stocks outperformed. The main reason for that, and it's interesting because we're starting to see that shape up this year, right? Emerging market stocks are starting to outperform. International stocks starting to outperform with this the move we've seen today. And so we're kind of echoing some of this pattern, the transition period, and maybe the start to a new year. And I think the main reason for this is that economic and earnings growth were improving for most countries in 2017. And as we often point out, economics have more of an impact on elections than elections do on economics, and certainly on the market. So in 2025, we expect economic growth in most countries to reaccelerate, providing a boost to more economically sensitive companies, which are just more prevalent in non-US markets, especially emerging markets like China. So again, it's interesting that so far this year, we're seeing emerging market stocks outperforming the S&P 500, as if that pattern's repeating itself once again. But of course, there are risks to the global growth that's driving this performance, as we pointed out in our last commentary published in mid-December that was entitled Top 5 Surprises for 2025. And one of those, Michelle, was a potential supply chain disruption. Michelle, are we looking at another potential port strike coming down the pike here that could impact global growth?
Yeah, we had a 3-day strike affecting the U.S. East and Gulf Coast ports by the International Longshoremen, and that was with the U.S. Maritime Alliance in October. And that ended with an extension to the contract, and that extension expires on January 15th, so just in a week. An increase in pay was agreed to, but the extension allowed for negotiations to continue on the use of automation and a longer-term agreement. Now, the union wants no automation and no semi-automation. Now, the previous longer-term contract allowed for modernization with guarantees that no jobs would be lost to the use of automation. Now, coming down to the wire, Maersk last week, that's the world's second largest container carrier. They're urging customers to remove cargo from the ports on the East and Gulf Coasts before January 15th.
Wow. So the automation issue is an important long-term issue. U.S. ports are the least efficient in the world. We know that. They're ranked 370 ports in the world ranked by the World Bank in terms of their efficiency. The U.S.'s largest port, Los Angeles and Long Beach, is dead last. The U.S.'s second largest port, New York and New Jersey, ranked a below average 251. And the U.S.'s third largest port, Savannah, was also near the very bottom at 367. But that's a longer term issue of automation and efficiency. And that's very important long term to productivity and growth and trade. But what about the risk of a short term disruption here on January 15th?
Yeah, a short disruption may not have much of an impact on global inflation, but the longer the strike lasts, the greater the potential for upside to goods prices, as well as stock market volatility. Now, the rule of thumb is that it takes about a week to clear the volume of cargo from a one-day port strike. Now, the ports at risk handle 68% of all containerized U.S. exports and 56% of imports. Now, back in September, JP Morgan estimated that the strike could cost the U.S. economy $3.8 to $4.5 billion a day. Now, export-heavy economies such as Germany, China, and Japan could also see disruptions. Now, the USMX may feel that it's best to wait as long as possible to give in to any union demands, and therefore make it painful for importers, and then use that experience to force through a rate hike on importers. Now, as it relates to the broader issue of supply chain risk that we mentioned in that article, the potential for a port strike is just one of the possible disruptions. We could have a deportation of the Mexican-born population in the U.S. that could disrupt supply chains and result in labor shortages in some industries. And then an increase in tariffs could also result in some diversions in trade. Now, in Ontario, the province in Canada, now they've already threatened to cut off energy exports to the U.S. Now, exports from Ontario are really less substantial than those from Alberta. Alberta supplies 56% of all energy imports from Canada. Now, authorities in Alberta have said they aren't looking to ban exports to the U.S., but it's a risk. And both Mexico and Canada produce many automotive parts and finished goods destined for the U.S. And then lastly, disruptions to trade could result in job losses and hurt economic growth in all three countries. Now, the seriousness of the trade, the tariff and deportation threats by the Trump administration, they're difficult to measure. Both could be negotiation tactics, but they likely hold some element of truth. Deportation threats could be geared toward encouraging voluntary departures. Now, the potential for more limited goods targeted for tariffs mentioned in the Washington Post article today has since been reviewed by Trump himself in Truth Social. So, Trump has nominated individuals to positions that have a history of hawkish stances toward immigration and trade. And the timeline for executing these policies is really uncertain and could be subject to long, drawn-out legal fights. We'll be watching the supplier delivery times in the PMIs, as well as container freight rates. But I would caution that trends are difficult to discern at the start of the year due to the wind down of holiday shipments and the timing of Lunar New Year. And, markets are also going to be paying attention to any announcements and executive orders coming from the White House, and could be in for a volatile time, Jeff.
Yeah, no doubt about it. I mean, trade is going to be a huge issue. Supply chain issues are going to be big. Certainly big in the minds of the Fed, but big in the minds of investors as well. And just to circle back to the longshoreman issue. So I believe talks between longshoremen and USMX restart on Tuesday. So we'll be watching to see if there's any movement there, and obviously the data as it comes in as well. So interesting. Well, thinking about supply chains brings China to mind, and I think that one of the most interesting charts of 2024 was the crossover of the 30-year bond yields between China and Japan. I mean, this is just a remarkable chart. We tend to think of China as historically as just really booming growth, emerging market, and Japan is just this moribund, just like a stagnant economy. And so to see longer term yields, which reflect growth prospects and inflation prospects, see them cross over is very interesting. And just, wow, could they be changing places? I don't know. The Japan story we've talked about a lot, and Japanese stocks were among our favorites again last year with a 20% gain in the Nikkei 225 index as inflation seems sustainable and yields are rising and growth is expected to perform well and grow here in 2025. But China is a country that's expected to continue to slow, yet its stock market did okay last year, right? Right, Michelle?
Yeah, that's right. We covered China in our top 5 surprises for 2025. But China may have already surprised investors last year. The Hang Seng Index rose 20%, near the top of the best performing countries in the world. The MSCI China Index, which includes both the mainland A shares and the offshore H shares, rose 16%. Now, the difference between these indices really relates to sector concentration. There's a higher weight in financials in the Hang Seng Index and a larger proportion of tech companies in the MSCI China Index. Now, the gain in Chinese shares was really due to a flurry of announcements beginning in September, but we also saw some other surprises in December. We had the first dovish shift in the monetary policy stance since the global financial crisis by the Chinese central bank, and also an urging by the central government to local governments to offer cash handouts for the new year to people struggling with the cost of living. Now, that's not uncommon for the new year, but it did mark the second instance of cash handouts since October. Additionally, last week, China expanded the consumer trade-in program beyond durable goods to include smartphones, smartwatches, and tablets. And Chinese stocks, though, they've faded from that initial jump after the September announcements because investors are really waiting more details, more concrete details on fiscal support. The Chinese government may wait to provide that until they're able to assess the impact of Trump tariffs and until they're able to gather for the March National People's Congress. And Chinese stocks could be range-bound until then, Jeff.
Yeah, that's a while to wait, right? So I guess we had a better services PMI come out of China this morning, which is encouraging, but still, it's a while. We know China's economy hasn't really rebounded yet. It's still slowing. And so to wait until March, they constantly overpromise and underdeliver, and just another drag here waiting out until we get to the March National People's Congress for them to deliver on some of that, additional stimulus. So look, I want to wrap up our discussion before we take live questions by talking about U.S. exceptionalism. I had a piece in the Financial Times. One of the reporters there, I was working with them last week on a piece on NVIDIA and what it means for the U.S. and the relative performance to the rest of the world. And that published this weekend, so we want to check that out in the Financial Times. But I think the reason I did this is because among the phrases that appears most frequently in Wall Street outlooks for 2025 is U.S. exceptionalism. And that's a reference. I think it's misplaced because actually U.S. is probably going to slow a little bit this year in growth, and the rest of the world is going to pick up. And so, I think maybe that was more about last year, but it really is a reference to the exceptionally resilient growth of GDP looking back and the labor market in recent years compared to the rest of the world. And most importantly, that this has led to U.S. stock market outperformance. But I'm not so sure about that. So take a look at this chart. So this is the chart that was in the FT that I put together, and you may have seen it on my social media feeds. I've been talking about this. It's got some attention. So what this is you've got the orange line there, which is the EMU index. What's that? The European Monetary Union. It's the Eurozone, European stocks. Starting from the beginning of the bull market back in mid-October of 2022, that's where the bear market ended for the S&P 500 and a new bull market began that we're still in. And then the other line, the blue line, is the S&P 500 minus one stock, NVIDIA. You take NVIDIA out of the S&P 500 and you've got European stocks outperforming US stocks. Where's that US exceptionalism? Is it just one stock? Is that the exceptionalism? Maybe. I mean, we hear about US exceptionalism driving US stocks to outperform, especially those of Europe. But the reality is that many stocks and in many sectors, European stocks have actually outperformed the US. And this is measured in dollars, by the way. Yes, I know the dollar has strengthened, and that has been a drag on performance here recently. It's one of the reasons those lines sort of reconnected a little bit there. In the fourth quarter of 2024, we saw a big rise in the dollar. But despite all that, we still see over time similar performance, if not slight outperformance, by the EMU index there in orange relative to the S&P X NVIDIA in blue. Remember, enthusiasm for AI stocks began when ChatGPT was launched in November of 2022. So along with the start of this bull market was the start of the AI enthusiasm. And so I just want to point all that out. In fact, if you held the EMU index plus putting 7% in NVIDIA, So like if you had a portfolio 93% EMU, 7% in NVIDIA, which is the current weighting in the S&P 500, you would have outperformed the S&P 500. So the U.S. exceptionalism in stock market performance isn't so much about U.S. growth or its labor market. It's really about one country, one company, I would argue. Obviously a great company doing extremely well. We're going to hear from them this week, but an interesting take there on U.S. exceptionalism. All right. Anyway, set that aside. Okay, Heather, let's move to that chat Q&A.
Thank you, Jeff. I got a lot of questions coming in. One of the major ones that came in is kind of related to the disruption of supply chains. And the question is, if Trudeau Canada, how do you see that affecting the markets or even the economic response to any change in U.S. trade or tariff policy?
So you cut out there for a second, but I think Trudeau talking about resigning as leader of his party and maybe looking to appoint a new prime minister there. I think it's clearly designed to address not only his approval ratings absolute dismal, but he has a very bad relationship with Trump, and so given that that's such an important relationship, I think 71%. Correct me if I'm wrong, Michelle, Heather, 71% of Canada's exports go to the U.S. Huge relationship there. And some mid-teens percentage of U.S. exports go to Canada. It is our most important or second most important trading relationship, more important than China. And so the relationship between the leaders has to be strong. And it's just not going to be strong with Trudeau. So this is something he can do in order to put a new leader in that place who maybe has a better chance of creating a better relationship for Canada with the U.S. And looking forward, we'll see what that looks like. Trudeau did come to see Trump, met with him. That really didn't seem to change anything. So we'll see where that goes. But I think that's the idea. That maybe a new leader there will have a better relationship, and Trudeau can maybe create some kind of legacy there by maybe helping to select his successor. We'll see how that goes.
I think there's also the potential that there was a disagreement. There's what we've seen across the world really is fiscal spending, and tightening fiscal spending is uncomfortable. And then, as you mentioned, any kind of relationship with the U.S. But I guess Trudeau resigning is on the tape. Is that right?
Yeah, I mean, yeah, he was sort of clear about that. I think maybe the timing and all that is maybe still up. I didn't see whether that had been finalized or not. But yeah, it looks like that's going to be the case. I think that probably may de-escalate tensions between Canada and the U.S. rather than throw a monkey wrench into them.
Now, there's also news about governments in Germany and France having big changes as well. What are we expecting from the EU?
Yeah, so we went through. We're going to continue to go through a series of elections in the two biggest economies in Europe. Well, looks like the takeaway from that is not dramatic. We're still going to have fairly weak coalition governments trying to make changes. The budgets need to be tightened a little bit to meet European Union rules, and there's some question about where that comes from and whether they will or not. France had been on path to take its fiscal budget deficit from 6% down to 5%. It needs to get it to 3% a few years from now, 6 to 5. Looks like that was so upsetting that we've now got a new prime minister who's going to attempt to try something else. Maybe it'll be closer to 6%. The takeaway is that there'll be likely less fiscal tightening in Europe next year. Same thing in Germany. So maybe less austerity, if you will. It's not really outright austerity. You're still spending in excess of tax collection, but maybe less in that direction. That can mean a better outlook for growth, maybe less of a drag on growth from government policy this year. I don't think it's going to change the bond market very much. The bond market for French bonds have already kind of priced in this sort of threat that maybe they're not really on a path to fiscal solvency. Of course, neither is the U.S., neither are many other countries, but they had been on a path towards getting to a 3% target. I think 2027, I think was going to be the year where they were going to hit that 3% goal. That appears to be up in the air now. Doesn't matter. Yields in France have still come down. So even if spreads have widened versus Germany, the overall yields are down. So the macroeconomic impact of this is actually net positive. Yields haven't gone up, so not acting as a drag on growth. And now government spending, which is a component of GDP, is going to be maybe more robust, stronger than it had been previously. So maybe the net outlook for this is, a little bit of political turmoil, butting heads as they try and form these coalition governments where nobody agrees on anything. But what that means is probably status quo spending. And the takeaway from that is probably slightly better growth than had been forecast.
Thank you so much. Now, of course, with government spending, the big issue is inflation. We do have a question here about US CPI, which has grown 22% since 2020, but the M2 money supply has grown much larger at 39%. What is the better measure for investors to look at when trying to diversify their portfolios?
The money supply is something that the Federal Reserve used to target many, many years ago, and you should try and control the money supply. And what they found was that it was very difficult to do and didn't really have, wasn't really as impactful as they thought. The velocity of money has changed dramatically in a world of, online payments for things. So the velocity of money can change very quickly. And so you've got a lot of money out there, but it's not changing hands rapidly. It doesn't have that much of an impact. Likewise, you could have a smaller amount of money out there, but more rapidly changing hands, and it has a greater impact. So generally, the money supply is not something that monetary policy officials focus on. I think from time to time it's relevant, but for the most part, we want to take a look at the drivers of inflation and some of those things. One of my favorite things is looking at the Purchasing Managers Index, the PMI, of input prices. So what are companies paying for their inputs? Generally, 6 months later, they pass those on to customers, pretty much without fail. I frequently put a chart out there on my Twitter feed and LinkedIn just showing this incredible relationship. All through the last 4 or 5 years, we've been posting this, and it is just perfectly. Nothing's ever perfect going forward, but it really has done an amazing job of predicting where inflation was going to be 6 months from now. And what it's saying is, don't expect it to go down much further in the U.S. That we're not quite at 2%. We're probably not going to get to 2% given the input price situation. So that limits the Fed outlook. One of the reasons why we don't expect that many Fed rate cuts this year, versus what the Fed have been talking about or the markets have been focused on 3-4 months ago. And in part of that, just the stubbornness of inflation. I wouldn't say it's driven by money supply. It's driven by a number of different factors, but money supply being one of them, but maybe a smaller factor. There's plenty of other reasons. Services inflation, labor costs, which labor is 70% of the cost of anything produced. So when we take a look at those, and they remain fairly stubborn with a relatively tight labor market. I know we talked about the unemployment rate rising, but still at a fairly low level, and the overall job environment remaining fairly tight. Wages continue to advance. One of the reasons why the union there for the longshoremen continue to push for better wage gains and those types of things. So we'll see what comes out of that. But it looks to me that inflation is probably receded as much as we're likely to see, and there's the potential here in the coming years of a rebound, something that'll keep central banks engaged and not just simply cutting rates and then holding them for a long period of time. They could come back and we could even be talking about hikes again in 2026. So something we'll have to keep a close eye on.
Thank you, Jeff. And one country that actually seems to be having inflation headed in the right direction is Japan. Do we have any comments about the relationship, the US dollar versus the Japanese yen for the coming year?
Yeah, so, I'm going to write about this week, I think, this whole take. I think the Bank of Japan is likely to raise rates this month. And the market is sort of 50-50 on whether they do. I think they probably will. And signal that there's probably more to come. We heard that from Bank of Japan Governor Ueda today, talking about, kind of get ready because there are going to be some rate hikes. That should support the yen versus the dollar. It should be good news for Japan overall. It's one of the reasons why yields have been climbing, and getting sustainable inflation and wage-driven inflation is critical to Japan kind of ending these periods of decades of very slow growth and seeing things turn around and consumer spending pick back up again. When inflation rises, generally consumers begin to spend because the longer they wait, the higher the prices go, and that tends to generate more economic activity. So we'll have to see. Japan's economy is expected to accelerate this year, in part on the back of improving consumer confidence and rising wages. So we'll see how all that comes together, but there is the potential for some volatility later this year in that exchange rate, and maybe some risk of a carry trade upset in the markets again, as the Bank of Japan may hike rates for the first time since, July 30th or 31st, when they hiked of last year. which caused that abrupt sell-off in the markets of 6 or 7% in the S&P 500 in August, a big contributor to that. So we'll keep a close eye on that, keep you informed as to how that's shaping up. Well, all right. Thanks very much for those questions, and thanks Heather and Michelle and our producers, Andrew and Gabe, and everyone for all those great questions and for joining us. Tune in each week at 11 a.m. Eastern or catch the replay on YouTube. Also, be sure to like the show and share your comments on what you're watching in the markets. We always like to see those. Thanks, and we'll see you again next week.